Welcome back to the Pro Ticker Podcast, your Saturday morning edition covering major financial magazine headlines.
Absolutely.
This week has
Yeah.
been a roller coaster in the markets
Yeah.
as we inch closer to that nail-biter election.
Oh, yeah.
And honestly, some of these headlines have my jaw on the floor.
Yeah. It's definitely been a week for the books.
Right. Like NVIDIA replacing Intel
I know.
in the Dow Jones Industrial Average.
That's huge.
According to both the Wall Street Journal and Bloomberg,
Right.
this is a pretty momentous shift.
Yeah.
It makes you wonder what it really tells us about the future of tech.
It's hard to overstate how symbolic this is.
Right.
Like NVIDIA, the AI chip giant, is basically the poster child for the current AI frenzy.
Yeah.
Their stock has exploded.
Oh, yeah.
We're talking a 900% increase
Wow.
in just 2 years, according to Bloomberg.
Down 100%.
900%.
That's insane.
Meanwhile,
Yeah.
Intel, a company that once ruled the chip world,
Right.
is struggling to keep pace.
I know, it's crazy.
They even had to pause their dividend this year, which the Wall Street Journal points out is a pretty drastic move for a company of that stature.
Okay, 900%. That's the kind of growth that makes you wonder if we're headed for another tech bubble.
Yeah.
I mean, remember the dot-com crash?
It's a valid concern.
Right.
Bloomberg even raises the question of whether this AI-driven rally is sustainable.
Yeah.
Are investors getting ahead of themselves?
Mm-hmm.
It's easy to get caught up in the excitement, but as history has shown, bubbles can burst.
Yeah, they can burst for sure. And when it comes to Intel, both Bloomberg and the Wall Street Journal suggest they missed the boat on the initial AI wave
Huh.
and are now playing catch-up.
Yeah.
Is it too late for them to regain their dominance?
That's the million-dollar question.
Right.
The tech world moves fast, and it's unforgiving.
It does.
It's not just about catching up. It's about anticipating what's next.
Right.
And right now, the future seems to be all about AI, which brings us back to NVIDIA and their meteoric rise.
Yeah, like it really is just like watching a changing of the guard in real time.
It is.
And it's not just limited to the tech sector. Sherwin-Williams, the paint and coatings company,
Right.
is also joining the Dow, replacing Dow Inc.
Yeah.
Again, according to both the Wall Street Journal and Bloomberg.
Interesting. So the Wall Street Journal suggests that this move reflects the incredible growth Sherwin-Williams has seen over the past 5 years.
Okay.
It also points out that Dow Inc. has become a smaller entity since splitting into 3 separate businesses in 2019.
Interesting. So a combination of growth and size seems to be driving these changes in the Dow.
Yeah.
But speaking of changes, let's dive into that jobs report.
Okay.
A mere 12,000 jobs added in October.
Wow.
That's a significant slowdown.
It is.
And it's no surprise. It's got everyone talking, especially with the election just days away.
Yeah, of course.
Right.
But as the Wall Street Journal emphasizes, you have to look at the context. We had Hurricanes Helene and Milton hitting last month, and the Boeing strike took a toll as well.
Oh, right.
Those factors likely skewed the numbers.
So not necessarily a sign of a weakening economy, but more like temporary turbulence
Right.
caused by these external factors.
That seems to be the prevailing opinion.
Okay, good.
However, you can bet both presidential candidates are spinning it to their advantage.
Absolutely.
For sure.
The Wall Street Journal even mentions how former President Trump's campaign is calling it a catastrophe
Oh,
and placing the blame squarely on Vice President Harris's shoulders.
I see.
I'm sure the Harris camp has a counter-argument.
Of course. The Wall Street Journal notes that they're highlighting the current unemployment rate, which at 4.1% is still historically low.
Right.
They're painting a picture of a resilient economy despite the recent slowdown in job growth.
Classic political maneuvering.
Yeah.
But putting the election aside for a moment,
Yeah.
what does this jobs report mean for the Fed?
Right.
They're meeting next week to decide on interest rates.
Yeah.
And everyone's wondering if they'll cut them again.
Well, despite the mixed signals from the jobs report, Bloomberg reports that the market seemed pretty convinced another rate cut is coming.
Another one.
Yeah.
But why? If the economy is supposedly doing okay, as the Harris camp claims, why would they need to cut rates again?
It's all about risk management
Okay.
and trying to engineer a soft landing for the economy.
Uh,
Bloomberg quotes several economists who argue that continued gradual easing is the best course of action, even if the job market seems to be holding up relatively well.
so the Fed is basically playing it safe trying to preempt a downturn rather than reacting to one after it happens.
Precisely. They're taking a long-term view, and they're not just focusing on the immediate data points. They're looking at the broader economic landscape, and they're seeing potential warning signs that warrant a cautious approach.
That makes sense. But what does it mean for someone like me
Right.
trying to navigate the market and make smart investment decisions? Should I be adjusting my portfolio based on these potential rate cuts?
That's a question for a financial advisor who understands your specific goals and risk tolerance.
Okay.
But what I can say is that understanding the Fed's rationale and the potential implications of their actions is crucial for making informed investment decisions.
Knowledge is power, right?
It is.
And speaking of knowledge, let's turn to the latest GDP figures.
Okay.
Barron's reports that the U.S. economy grew at a healthy 2.8% in the third quarter.
Wow.
And here's the cherry on top. Inflation cooled down as well.
It does seem like we're in a sweet spot right now with solid growth and easing inflation.
Yeah.
But the question on everyone's mind is,
What's that?
how long can this Goldilocks scenario last?
Right. Barron's quotes economists who are cautiously optimistic, but also flag potential risks on the horizon, especially if the economy continues to operate above its potential for an extended period.
It's a balancing act.
It is.
And with the election just around the corner and the Fed making these big decisions, it's definitely a time for investors to stay informed and keep a close eye on the markets.
For sure. Speaking of keeping an eye on things,
Yeah.
we've got this whole saga with the Trump whale making waves in the prediction markets.
I know.
This has been fascinating to watch unfold.
It has.
It's like something out of a movie, right?
Yeah.
The Wall Street Journal has been all over this story.
Oh, yeah.
Apparently, this mysterious trader who goes by the alias Theo has bet over $30 million on a Trump victory.
Over $30 million.
Yeah.
That's not just playing the market. That's making a statement.
Right.
And what's really intriguing is that he's making this bet despite the polls showing Trump trailing behind Harris.
Exactly. It
Yeah.
makes you wonder what his angle is.
Right.
Is he a diehard Trump supporter with deep pockets and a gambler's spirit?
Yeah.
Or does he know something the rest of us don't?
Well, the Wall Street Journal actually managed to track down Theo for an interview.
Oh, wow.
And he insists it's not about manipulating the election or pushing a political agenda.
Oh, okay.
He claims he's simply trying to make a profit and believes the polls are underestimating Trump's support.
So a savvy investor who sees an opportunity where others see risk.
Yeah.
Or maybe a bit of both. It's hard to say for sure.
Right.
But the whole thing raises some interesting questions about the influence of wealth in prediction markets.
It definitely does.
Right.
Imagine the sway a single individual can have with that kind of money.
Yeah, it's kind of scary.
It's a reminder that markets aren't always driven by pure logic or data.
Right.
Sometimes it's about gut feelings, calculated risks, and maybe even a bit of blind faith.
And speaking of big money, we can't forget about those eye-popping fees Boeing's bankers are pulling in from its recent capital raise.
Oh, yeah.
Bloomberg has the scoop on this one.
Okay.
Boeing raised over $20 billion.
Wow.
And their bankers are expected to pocket a cool $300 million in fees.
$300 million.
Yeah.
It makes you wonder who's really benefiting from these mega deals.
Right.
But in all seriousness, Bloomberg points out that share sales are having their best year since the IPO boom of 2021.
That's a good point. It seems there's still plenty of appetite for deals despite the pre-election jitters.
There is, but Bloomberg also notes that things have slowed down a bit in recent weeks as companies wait to see how the election unfolds. It's a classic case of wait and see. Nobody wants to make a big move until they have a clearer picture of the political landscape.
Speaking of strategic maneuvering, let's talk about Amazon's big bet on nuclear power.
Okay.
Bloomberg reports that they hit a roadblock.
Oh.
A U.S. regulator just rejected a deal that would have given Amazon access to more power from a nearby nuclear plant.
Interesting.
So what happened?
Well, Amazon was hoping to secure a direct line to a clean energy source for their power-hungry data centers.
Right.
But the Federal Energy Regulatory Commission, or FERC, wasn't convinced. According to Bloomberg, they had concerns about grid reliability and the potential impact on customer rates.
So it's not just about finding clean energy sources.
Right.
It's about integrating them into the existing grid in a way that's both reliable and fair to all consumers.
It's a complex challenge.
It is, for sure.
Yeah.
And this FERC decision could have ripple effects throughout the industry. Bloomberg suggests that other energy companies were hoping to strike similar deals with tech giants.
Right.
selling them power at a premium.
Yeah.
Now, those plans might be on hold as they assess the implications of this ruling. It's a reminder that the energy landscape is evolving rapidly, just like the tech world.
It is.
There are opportunities, but there are also challenges.
Definitely.
And sometimes the best-laid plans run into regulatory hurdles.
Speaking of hurdles, let's shift our focus to Germany,
Okay.
where things are getting interesting, to say the least.
Oh.
Bloomberg reports that the German government is facing a potential financial crisis.
Okay, this sounds serious. Tell me more.
Well, it all comes down to a case that's currently before the German Constitutional Court.
Okay.
The court is considering whether the so-called solidarity surcharge, a tax levied on higher earners and companies to help cover the costs of German reunification, is actually constitutional.
Interesting.
If the court rules against the government, it could wipe out a staggering 75 billion euros in tax revenue.
75 billion euros.
75 billion.
That's a massive hole in the budget.
It is.
What are the potential consequences if this happens?
Well, Bloomberg outlines a few scenarios.
Yeah?
None of them good. It could deal a devastating blow to Chancellor Olaf Scholz's already fragile coalition government.
Okay.
It could force them to lift constitutional borrowing limits.
Wow.
And it could further weaken the German economy, which, as Bloomberg reminds us, is already projected to contract for the second consecutive year.
So it sounds like Germany's economic and political stability is hanging in the balance.
It really does.
This court case has the potential to create shockwaves, not just in Germany, but across Europe and perhaps even globally.
It really does. And this case highlights the delicate interplay between legal challenges, political maneuvering, and economic realities.
Right.
It's a reminder that seemingly isolated events can have far-reaching consequences.
It's true. Speaking of events with potential consequences,
Yeah.
remember that contrarian stock market indicator we discussed earlier, the Boveselside indicator?
Right.
Well, MarketWatch reports that it just hit a 2.5-year high.
That's right. And for those who may not recall, contrarian indicators are designed to do the opposite of what the majority sentiment is suggesting.
Right.
So in this case, while the market is generally feeling bullish, this indicator is flashing a warning sign that things might be getting a little too optimistic.
So it's like a canary in a coal mine.
Exactly.
Signaling that a correction could be on the horizon.
Exactly. MarketWatch quotes Bank of America strategists who are advising investors to be selective and look for opportunities in areas of the market that haven't seen as much love lately.
So what kind of opportunities are they talking about?
They suggest focusing on stocks with high dividend yields, large cap value stocks, and those in cyclical sectors. These tend to be more resilient when the market takes a breather.
So a little bit of cautionary advice, but not necessarily a full-blown panic signal.
Right.
It's more about being prepared and recognizing that the market moves in cycles.
Exactly.
What goes up must eventually come down.
And we've been on a pretty long upward cycle, haven't we?
We have.
A bit of a cool down might not be such a bad thing.
Right.
It could give the market a chance to consolidate its gains and set the stage for future growth.
Fingers crossed. But all this talk about market indicators and economic data can get a bit overwhelming, can't it?
It definitely can.
It's like trying to drink from a fire hose sometimes.
But it's important to remember that you don't have to become an expert overnight. Take it one step at a time, focus on understanding the underlying trends, and don't be afraid to ask questions.
Speaking of understanding the underlying trends,
right,
we haven't touched on that recent news from Bloomberg about U.S. regulators and data centers.
Oh, right.
This one seems pretty technical.
Yeah.
But I'm sure you can break it down for us.
You're talking about the Federal Energy Regulatory Commission dealing a blow to tech companies hoping to power their data centers with electricity generated right next door.
Yes, that's the one. What happened exactly?
Well, as Bloomberg reports, FERC rejected a deal that would have allowed Amazon to significantly increase the amount of power its data center in Pennsylvania draws from a nuclear plant owned by Talen Energy, which happens to be located right next door.
So Amazon was trying to get a direct line to the power source, and the regulator said no.
Essentially, yes, FERC felt that this arrangement, known as a behind-the-meter arrangement, didn't adequately address concerns about potential negative impacts on grid reliability and customer rates.
Behind-the-meter arrangement. That sounds like something straight out of an electrician's handbook.
It's actually a pretty straightforward concept.
Okay.
It basically means that a large electricity consumer, like a data center, sets up shop right next to a power plant and gets its electricity directly bypassing the traditional grid.
Ah, I see. Like cutting out the middleman.
Right.
But it sounds like the regulators worried about potential loopholes and unintended consequences.
Exactly. FERC's job is to ensure the reliability and fairness of the electricity grid for everyone, not just big tech companies.
That makes sense.
Yeah.
But it also highlights the challenges of balancing clean energy goals with the complex realities of grid management.
It certainly does. And this case is likely to have ripple effects throughout the industry as both tech and energy companies grapple with its implications.
Well, one thing's for sure, the worlds of business and finance never stand still.
It never does.
There's always something new happening,
Yeah,
some new trend to analyze, some new challenge to overcome.
absolutely. And as we head into the final weekend before the election, we can expect even more twists and turns.
I can't wait. But before we get completely swept away by the pre-election frenzy, let's remember that investing is a long game.
Wise words. It's easy to get caught up in the day-to-day market fluctuations, but staying focused on your long-term goals is key to building a solid financial future. Speaking of building for the future, what are your thoughts on that SMCI short seller story from Yahoo Finance? Remember Supermicro Computer, the AI server maker?
Well, that was a wild one. Yahoo Finance has been following the drama. It seems like the short sellers made a killing, raking in something like $2 billion as Supermicro stock plummeted by 40% in recent weeks.
It was a perfect storm of bad news for Supermicro.
Yeah.
It started with that scathing report from Hindenburg Research alleging all sorts of shady accounting practices.
Right.
Hindenburg is known for its hard-hitting reports, and this one really shook investor confidence.
And then to make matters worse, their auditor, Ernst & Young, resigned.
Yes, and their resignation letter, which Yahoo Finance quoted, was pretty damning.
Yeah.
They basically said they didn't want to be associated with the company's financial statements.
Ouch.
And then, as if things couldn't get any worse, the Wall Street Journal dropped the bombshell that the Justice Department is now investigating Supermicro.
Talk about adding insult to injury. It's a stark reminder that even in the exciting world of AI and high-growth tech, due diligence is crucial.
Absolutely. Don't just get caught up in the hype. You have to look under the hood and make sure the company's financials are solid.
Right. A valuable lesson for all investors.
Yes.
But on a lighter note, let's talk about a stock that's become a proxy for the election itself.
Yeah.
Trump Media and Technology Group, or DJT as it's traded.
Oh, DJT.
Yeah.
The stock that's as unpredictable as the man himself.
It really is.
Yahoo Finance has been charting its wild ride,
Yeah.
and it's been quite a show.
It has. Just this past week, the stock dropped about 20%.
Wow.
And Yahoo Finance noted that it even experienced multiple trading halts.
Really?
That's pretty unusual, isn't it?
It suggests a lot of speculative trading is going on with investors reacting to every little bit of election-related news.
Right.
One investor, Matthew Tuttle, is quoted in Yahoo Finance saying that investing in DJT is a binary bet on the election.
Okay.
If Trump loses, he predicts the stock could go to zero.
Zero. That's a bold prediction.
It is, but it highlights the extreme uncertainty surrounding the company's future.
Yeah.
Its fate seems inextricably tied to the outcome of the election.
It does. We'll know soon enough what the future holds for both Trump Media and Technology Group and the country as a whole. The anticipation is building.
It is. The election is just days away and the tension is palpable. But in the meantime, let's focus on what we can control.
Yeah.
Staying informed, making smart investment decisions, and not letting emotions drive our actions in the market.
Right. Speaking of emotions running high.
Yeah.
Remember how Meta and Microsoft took a hit after their earnings reports, even though they beat expectations? It seemed like investors weren't impressed, even though the numbers were good.
Right.
What spooked them?
It was their future projections, specifically their capital expenditures or CapEx, that raised eyebrows.
Okay.
Both companies signaled that they expect CapEx to keep rising as they pour more money into AI.
But isn't investing in the future usually a good thing?
It is.
Why would that worry investors?
Well, normally you'd be right. But there's a growing sense of impatience among investors when it comes to AI.
Okay.
They want to see a clearer path to profitability from all this spending.
Right.
It's like they're saying, okay, you're betting big on AI, but show me the money. When will these investments start paying off?
So it's not just about spending.
Right.
It's about demonstrating a return on that investment.
Exactly.
But wait, didn't Amazon also announce massive CapEx plans?
They did.
Yet their stock soared after their earnings report.
And that's what makes this so interesting. Yahoo Finance points out that Amazon, along with Google, has essentially provided a playbook for how to calm investor fears about heavy AI spending.
What's their secret?
They've shown that their core businesses are strong, generating enough profit to support these big AI bets.
Okay.
It's about striking a balance,
Uh-huh.
investing in the future, while still delivering solid results in the present.
Got it.
It gives investors confidence that these AI investments aren't reckless gambles,
Yeah.
but calculated risks with the potential for long-term growth.
So a lesson for other tech giants navigating the AI revolution.
Yeah.
It's not just about spending.
Right.
It's about demonstrating a clear path to profitability.
It is.
And it's about making sure your core business is strong enough to support those ambitious bets on the future.
Well said.
Yeah.
It's all about finding that sweet spot.
Well, that about wraps up our deep dive into this week's financial news. From AI shakeups in the Dow to the Trump whale to the energy challenges facing tech giants, it's been a week full of surprises.
It has. And as we head into election week, the only thing we can be sure of is more volatility.
Oh, yeah.
So buckle up and get ready for the ride.
And remember, knowledge is your best defense against fear and uncertainty. Stay informed, stay curious, and don't be afraid to ask questions. We'll see you all tomorrow morning with new headlines from major financial magazines.